Welcome back, ladies and gentlemen, to the FPSO World Congress Live 2020 on the 8th of September for our Market Intelligence and Project Financing Day. Now, coming up next, we have a very interesting session on financing. And with us, we have a total of 6 industry experts who are here to share their insights. So, Dave, I'd like to invite you to once again introduce our moderator for this session. Dave, please.
Thank you very much, Jamie. Yeah, we've had a great Congress so far. We've heard about projects, we've heard about technologies, we've heard about operations and maintenance, and this morning, or a little bit earlier, we heard about some prospects for the market. It's very important for us to hear from the next group of people about the availability of funding and finance, what kind of capital we're competing for with our industry, what do we have to do to attract that. Are there ESG considerations in this? So looking forward to hearing from all that. We've got a great moderator, Ben Rose, who's a partner in Singapore, head of shipping and offshore Asia for Norton Rose Fulbright. Ben specializes in asset and project finance with a focus on offshore oil and gas and shipping finance. So I'm sure he sat across the table with a number of these gentlemen on the panel. So I'd like to hand over to you, Ben, to introduce your panel.
Yeah, thanks, David, and good afternoon to those of you in Asia. Good morning to those of you in Europe, and yeah, my thanks to IQPC for giving me the opportunity to moderate this financing panel discussion today. So first off, I'd like to start by introducing my panelists. First, I have Shiv Sivaraja, Head of Energy and Resources for Asia and Oceania at MUFG. Shiv joined MUFG's Energy and Resources team in September last year. He's responsible for coordinating the bank's energy sector activity across Asia. Prior to that, Shiv was Head of Offshore Energy for ING Bank in APAC for the last 5 years. He's been a banker for 19 years. Next, we have Melvin Gui, Director in the Infrastructure and Project Finance team at Natixis in Singapore. Melvin specializes in the offshore oil and gas sector. And during his career, Melvin's coordinated and arranged floating asset transactions for clients in multiple jurisdictions, including Brazil, Africa, Asia, and Australia. Third, we have Dindo Abueg, co-head of project finance for Asia Pacific at KDB. Dindo is a senior banker with a 25-year background in project and structured finance. He's also based in Singapore and is responsible for building the project finance practice for KDB in overseas markets. Prior to KDB, Dindo worked in the export finance and energy and infrastructure teams for Natixis, West LB, Deutsche, and BNP Paribas. Fourth, we have Siddhartha Shrivastava, Deputy General Manager and Head of Energy and Natural Resources in Asia for SMBC in Singapore. Siddhartha has more than 16 years of experience in banking and finance and has worked with multiple global and Asian oil and gas companies to raise non-recourse financing for their projects in Asia. In the LNG sector in particular, he's led several notable advisory and arranging transactions for LNG liquefaction projects in Indonesia, Australia, and PNG, as well as LNG regas projects in Bangladesh, Indonesia, and Pakistan. Finally, we have Dorian Delteil, Head of Oil and Gas for DBS Bank here in Singapore. Dorian joined DBS in March last year, and his experience encompasses project acquisition, corporate and structured financings, and bonds. And prior to DBS, Dorian worked in the oil and gas teams at Standard Chartered for 6 years, and then prior to that, SMBC and Credit Agricole for 10 years. Dave has already introduced me. Ben Rose, I'm a partner and head of shipping and offshore at Norton Rose Fulbright in Singapore. So as we've heard during this conference, and as everyone knows, the oil price has been on somewhat of a roller coaster ride over the last few years. From a low of $17 in late 1998, up to a high of $150 in May 2008. back down again to $50 at the start of 2009, and then up to $130 2 years later. In the last major downturn in 2016, the price was down to $26, though it did rise again, of course, at the end of 2018 back to $77. We all know the effects of COVID in slashing the oil prices earlier this year to just around $11, although they're now back to around the $42 mark, albeit through intervention from OPEC+. So during that last oil and gas downturn in 2016, there were no new orders placed for FPSOs. However, since then, demand has returned pretty strongly. And certainly at the start of this year, we were expecting 10 to 12 new FPSO awards this year, mostly in Brazil, and then 12 or 13 awards every year going forwards. COVID has obviously put the brakes on that, and energy transition is further impacting the demand for natural resources. So those predictions obviously now seem high, particularly we heard from in the last session about that. But we still have seen a number of LOIs issued this year for large capital-intensive FPSO projects. I think International Maritime Associates predicted at the start of this year that the industry would see between 41 and 56 new FPSO orders over the next 5 years, with 26 of those in Brazil, which obviously begs the question, where is the financing going to come from? So after that, sorry, slightly long introduction, I'll turn to my panel. I'll start with Dorian to ask for your views, Dorian, on the continued importance of oil in the world energy market, particularly given the events of this year.
Hi, Ben. Thank you very much. And good afternoon to everyone, or good morning for those who may be in another time zone. Definitely a challenging year for everybody involved in that sector. And as you just mentioned, Ben, we were beginning the year full of hopes, a lot of tenders in the market. We were expecting a lot of awards, and effectively everything has changed. So it's put a lot of pressure on the remaining awards or letter intents contractors in order to raise their financing. What are the sources of capital available? And across that, which banks are to support them, depending on the project location, depending on the sponsor, on its profile, how it may evolve, how it may be impacted by all this crisis. So challenging times with several other implications, I would say, in terms of structuring and in terms as well of what are the perspectives in respect of this oil price going forward. Do we think it will remain challenging? Are we more focused as well on the upstream economics? We may not want to be facing incentives in terms of lease rates, renegotiation in the future. So all this is basically what is at stake for us, the financiers, the bankers, when we are looking at a new project these days. More complicated, more challenging compared to before. And when I say before, it was really roughly 4 months ago, I would say. So a lot of mind changing, rethinking across all these elements.
Thanks. Yeah, and I mean, staying on the same subject, but I'll ask Siddhartha, what do you think of the predictions in terms of an increase in demand for production over the next few years and that activity level that I was talking about? Do you think that activity is likely to return to those historic levels?
Thanks, and good afternoon, everyone. So that's a very, very interesting question, and I really need a crystal ball to gaze into and get to that answer. But I personally am of the view that we are, the markets in general have overreacted with what happened in April, May. And I think it's pretty evident that by June, July, I think there was a bit of realism that came back to the market. And the price cycles, which are generally another factor for demand cycles, it's nothing new in oil price, in oil world. I mean, back in 2014-15, we have already seen oil going off a cliff from $140 to $30, and that was not topped this time around. Now, to answer your question specifically, what has changed this time? I think there is a real, honest, constant shift in conversations in terms of how much oil is really needed. And I think that's creating the uncertainty, because in 2015, the discussion is still that how much oil world would need and how fast would we get there. And the question now is, do we need oil? And do we have renewable sources? Do we have alternative energy sources? We have seen how some of the major oil companies are taking this opportunity to focus on other alternate energy channels. So I would definitely say that the activity has to come back. I think within SMBC, we believe that we cannot remain where we are today. I think pace of recovery, and have we reached the peak oil, or is that maybe not too far off? I think those questions, I believe, are definitely valid. And immediate impact, I think, to echo what Dorian was saying, is I think a lot of these investments in FPSO projects, they are long-term investments. I think some of the deals in Asia might be 10 years, but the moment you get to your Brazil or Western Africa, you're looking at 20, 25-year contracts. And I think there is a definite discussion within banks. Is this asset being developed? Is it going to be relevant for the world energy needs for 20, 25 years? And I think that becomes an important discussion factor, not only for the banks, but I think also for the developers. I think the burden of proof has shifted a bit to the project developers to justify to the financing community that this is a right investment and relevant investment.
Okay. Yeah, thank you. Thanks, Siddhartha. I'm going to ask the same question, albeit slightly differently, to Shiv, but I just wanted to ask what your view and your bank's view was of lending into the oil and gas market at the moment, given this roller coaster ride of oil prices and the supply and demand issues facing the oil industry generally.
Yeah, thanks, Ben, and thanks to Siddhartha and Dorian for kicking us off. I mean, I don't see what the problem is. I think everything's fine. I think we should all be just lending as much as possible now. I'm kidding. Obviously, I think that my peers have sort of summed up a couple of very key points very nicely, which is that actually this is a really, really unprecedented, shocking time. You know, we all thought 2015 was bad. This is really, really different. It's completely global now. It's not just an oil market issue. Like, everybody's concerned about pretty much every sector. And I think that, unfortunately, this was meant to be the year that we really start to see a proper recovery in the oil markets, because let's not forget, we had a really difficult last 5 years. And actually, you know, we were sort of thinking, right, it's time to get some investment back in and time to start looking at the survivors in this market. So if I take a slightly more bullish view, and I'll try to be bullish even though I'm primarily a lending banker, the oil industry has, because it's had quite a difficult last few years, is possibly one of the best equipped industries to deal with what's currently going on. You know, if you look how quickly a lot of the upstream companies reacted when things started going a bit wrong, say in March, i.e. when OPEC Plus had the fallout and the oil price basically halved, they very quickly cut CapEx, they very quickly made the right statements about liquidity, and they very much made it very clear to stakeholders that they were very prepared for potentially low oil prices for a long time. Nobody sat on their hands. And I think that's a function of management teams and people who've just spent the last few years dealing with a crisis, right? They're very ready, they're very battle ready. And I think that's been extremely helpful. But secondly, you know, we haven't had as much investment as perhaps we need to deal with the maturing oil fields that are out there. And over the last 5 years, it's been noticeable that we haven't had as much investment, not just offshore, but even onshore, just generally across the world. So actually, we needed this year, in terms of just keeping up with where oil demand is expected to be, at least for the next few years, we needed this year, we needed production this year to start sort of ramping up. So we're putting things on hold, in my view, but I believe a lot of this stuff's going to come back. A lot of this investment is going to come back. I'm not sure exactly when, I'm hoping next year, but I think it has to. And to my mind, at least, as long as the companies continue to behave in a very prudent manner, and the world starts to normalize a bit, I think there's appetite to still back the right projects and the right companies in the space.
Great. Yeah, thanks. We've talked a lot about the oil space or oil market generally. I think I'm conscious we should move on specifically to FPSOs. And my statistic, whether it's right or wrong, what I read was 41 to 56 large new FPSO orders over the next 5 years. And therefore, where is the financing going to come from? So maybe this next sort of section, I can ask about sources and methods of financing FPSOs specifically. So Dindo, perhaps we could hear from you. Why don't we kick off with your views on project finance versus corporate finance versus, say, vendor financing, et cetera, as methods of financing FPSOs and your views on those.
Thank you, Ben. Good afternoon. Good afternoon to everyone. Yeah, definitely. Oil and gas will remain to be one of the most important energy sources. And I think, and this asset class, FPSO, will remain to be one of the more favored assets, particularly because of the way it's structured, especially on its the way revenue structure, where you get basically more like an availability revenue stream there. So basically, it avoids market risk. So this is basically a very good candidate for project financing, where you look at the cash flow of the project, very minimal market risk. You look at the charterers. And I think if you look at all the recent transactions, FPSO financing that happened in the past, I think most of these were done through project financing. You could see this in Africa and South Africa, even in Asia. Project financing is beneficial basically because it's non-recourse to the sponsor. And you can basically get a longer tenor as compared to corporate financing or even vendor financing. The disadvantage for project finance is probably more tedious because you really have to study the credit risks of the project as compared to the corporate financing where you look at the balance sheet of the sponsors. I think next to project financing, it's actually corporate financing where you see most of the transactions are. And then I think last year there was a vendor financing where one of the, I think, sponsor bought an FPSO from, I believe it's Chevron. And that was, I think, only a 3-year financing.
Thanks. Yeah, that's interesting. I obviously appreciate project financing is the main method that we're most of us spend our lives looking at. So perhaps we look at ways of supporting that financing. So I move on to ECAs, and particularly given, you know, we all know that Brazil has close to half the entire global demand for FPSOs, I think, this decade. I think that they're responsible for awarding 3 or 4 FPSO contracts a year and up to 26 potential new units to enter operations by 2026. So maybe direct this question to Melvin. How important are the ECAs currently, particularly given that concentration of activity in a few key locations, mainly Brazil, and the size of those deals that we're seeing now?
Yeah, thanks, Ben. And hello, everyone. I think it's a very good question. I think naturally the advantages and disadvantages of ECAs are quite well known. They obviously play an important role in Brazil, particularly given the number of mega FPSO projects, in excess of 1 billion capex that's available in the region. And I think generally they are there to fill a funding gap. Processes are generally complicated with the ECAs. I think that kind of goes without saying. But I'll kind of leave this point into thoughts. I think one, different ECAs will obviously attract different liquidity, and that obviously will need to be balanced in any type of financings. And secondly, I think traditionally the European and Japanese ECAs have been very supportive towards the FPSO sector. So to the best of my knowledge, these ECAs continue to be active. But it's kind of worth keeping an eye, obviously, in the context of that wider climate imperative, especially happening in Europe and other parts of the world. If this continues, to be the case for the ECAs, I guess, in the mid to longer term.
Yeah, thanks, Melvin. You touched on two things that I probably want to ask. I'll ask other panelists, but in terms of drawbacks and local content requirements. So maybe Dorian, I put you on the spot to talk about some of the potential drawbacks of ECA financing, and I guess particularly where you end up with multiple ECAs involved. How do you find that affects a financing transaction?
Sorry, you can hear me? Yeah.
Yes.
Look, these ECAs are fundamental these days. They bring liquidity and they support the contracting strategy. The more you would have, the more complex and the more constraining it can appear from a borrower perspective, because these ECAs have effectively a lot of specific requirements, due diligences on this, on that, and whatever. But the advantage is liquidity will be on the table. So whatever this is the case, it's always to the benefit of a project from a borrower perspective, and also from the lender's perspective, as through some form of umbrella and some political or commercial risk which could be covered as well. So I would never think or say that ECAs could be constraining or burdensome. I think they are fundamental these days. They've become more and more fundamentals over the past 10 years, and they will remain also through the banks facing higher cost of capital with Basel 3, 4, etc. So it's also, from an economical point of view, lowering a bit the financing costs from a borrower perspective. All of that is for the benefit of the project.
Thanks. And then the second point that Melvin raised, maybe I'll ask this to Shiv, was this idea of, there's normally a requirement for local content of some kind with ECAs, of course, and with these days more and more FPSO hulls being built in China for the Brazilian market, do you think it's harder to find ECAs willing or able to participate in these deals?
Look, really good question, and maybe before I sort of get into that, I think ECAs have got a critical role if we go down the traditional project financing of these deals, because frankly, they're getting really big, right? Particularly the ones in coming out of Brazil. Like the FPSOs are getting really big, they cost a lot, they require a lot of debt, and as Ben points out, there's quite a few of them coming. So it does mean that, the traditional bank liquidity probably has its ceiling, particularly deal by deal, and maybe also an aggregate. So the more liquidity you can get from export credit agencies, who are government agencies largely, and therefore capable of putting a lot more money on the table through insurance or directly, incredibly important, particularly for that traditional project financing. So I would say that, when you talk about content, ultimately there's pros and cons. The bigger and more complex an FPSO gets, the more different things there are in there from different places. And, the more of an opportunity you have to actually source from a country which actually has an ECA willing to support its exporter. But let's not forget, the dynamics of an export credit agency. Their main job, it's a government-linked organization, its main job is to support its exporter. Right. So if there is an exporter from that country that is going to benefit by the ECA supporting the ultimate project, then they will have a proper look at it. And the good news is, even if they're new to the FPSO world, the project financing of it and the legal terms of it, which firms like Northern Rose know inside out, are so well established that actually, it wouldn't take too long to catch up, right? We're not breaking new ground here with new product, or, it's not FLNG or floating sort of wind where, it's relatively new. This has been around for a long time. So I do think that, contractors should think very carefully about their financing strategy when they're preparing their own build strategy or construction strategy, because whilst a contractor may not seem particularly economical or particularly useful from a pure technical point of view, if it does bring in financing or it brings in liquidity that otherwise wouldn't be there because of its nationality, that's something I would consider right from the start. And the recommendation we've always made to our clients is to say, make sure that the finance team don't just get given the deal once the sort of tender's won. Make sure that they are closely linked to what's going on during the bidding stages, and even sort of understanding how the contracting strategy is coming together, because it's so critical now to get that project finance liquidity from the ECAs. So whether or not it's getting harder from China, hard to say. You're right, there's more happening there, but still quite a lot of equipment and topsides are still coming from overseas. Not everything is from China. But then again, more integrations happening in the Chinese yards. But then again, the Chinese ECAs have also got relatively sizable capacity.
Thanks. Yeah, thanks, Shiv. One similar to ECAs, but a few years ago we saw IFC-backed loans in the FPSO sector, and so maybe I'll direct this question to Dindo, who I know has worked in relevant export credit teams in the past. But where do you see the multilateral development banks these days, if at all, so the ADBs, IFCs of the world, in supporting FPSO financings, or as a way of finding more funding for these projects?
Thanks, Ben. That's a very interesting question, because if you look at the FSRU world, the FLNG, you've seen in these multilaterals supporting projects such as FSRUs. I think the most recent ones would be the ones in Bangladesh, where they were able, IFC was there to support one of the FSRU transactions. I believe ADB was also involved in one of the projects in Bangladesh for one of the FSRU projects also over there. So they've supported this kind of assets. Now the question is, we haven't seen them actually in the recent past where they've supported FPSOs. I think IFC only, I've seen the IFC's name probably in the last 10 years only, and haven't seen ADB participating in any of these FPSO projects. So the question is, are they really supportive of this kind of fossil fuels? We've seen some development banks, or like EIB, moving back from fossil fuel projects. So I'm not sure whether this is the kind of projects that multilaterals would be able to support. Having said that, we know that their charter mandates them to support projects that are in support of the development of the economy of a particular emerging country. So maybe it's a question that we could ask multilaterals.
Okay, thanks. Yeah, another area actually where we saw increased interest a few years ago was from Chinese leasing companies, who, at least we thought, were starting to make inroads into the offshore market. We worked on a transaction for CSSC, actually the $1.2 billion financing for the first converted FLNG carrier for Golar. So maybe I could ask this question to Siddhartha, whether you've seen any further interest or activity from the leasing companies in the FPSO sector, so whether Chinese or other leasing companies and leasing structures.
Thanks, Ben. So on the China front, I think to also mix it with the question you really recently asked, I think Chinese leasing companies have been out and about, and I think they have been a very, very interesting, and I would say depends, attractive source of fund, depends on who you are. Now, typically we don't necessarily see them as somebody who is working together with banks or ECAs, and they're part of a broader finance package. So there is typically a kind of competition. And I think they are alternative source of financing which is available. Now, it really depends on where exactly, what kind of project you are developing and what kind of access any developer has for these sources of financing. And in my experience, and I think it's been a limited experience working directly with the Chinese lessors, but my experience has been that the cost of funding is definitely higher when you are looking at that option. So that's an option that you would like to get onto when you have exhausted the ECA option, you have exhausted the bank option, or there are challenges in some of those. And it does make sense. I think what I would definitely say is that has brought in a quantum of debt, and they can, as you rightly said, especially in FLNG space, I've seen them actually do not one, maybe two FLNG deals with $1 billion plus checks. So that kind of liquidity alternate medium actually helps some of the newer projects, I think, some of the newer developers who may now have a right project, or maybe working with juniors, independents who in the current market environment may not immediately appeal to the banking community. But as long as they are not in an extremely competitive fee scenario where a certain cost of financing is going to severely impact the return for a developer, I think that option exists. I mean, post-COVID, and I think that's where I would not necessarily go in, whether that liquidity still is available post-COVID. I don't think I have seen any recent discussions about that, but I think definitely back in January, February, that was the alternative.
Yeah, thanks. In terms of then looking at other methods which potentially could be more expensive, I'll look to project bonds. And one of the problems, obviously, of attracting finance for FPSO projects we've talked about is the long-term nature, and that many commercial lenders aren't willing to do big ticket deals for a long tenor, whether that's liquidity constraints or concerns about their ability to access the interbank market at rates which match their cost of funding. So, in other fields of project finance, we've seen the use of project bonds. Now, so I'll move again, and perhaps I could move back to Melvin to ask this question. We certainly saw one that I know of, the MODEC $1.1 billion 15-year project bond, which they issued, I think, last year to refinance their MV24 FPSO. I think it was the first, maybe the second project bond in the market. So from your point of view, what attracted MODEC to the bond market? As from what I see, they have strong support from JBIC and the commercial banks. So what were the drivers for them and potential benefits?
Well, thanks, Ben. And maybe just to say that MODEC wasn't, I guess, the first contractor to issue project bonds. We have obviously SBM, who issued some bonds back in 2012 and also 14. But look, I think in the Asian space, project bonds are probably not that prevalent as compared to the Americas and Europe. And ultimately, I think from MODEC's point of view, or maybe for any contractor's point of view, I think especially if you're operating in Brazil, where the capex is, again, very high, then, I think the project bonds is a good way of recycling capital and releasing limits for banks, to also focus on construction financing. Question, I think, in today's climate is timing and pricing, because I think the bond market now is probably more open to operating projects. So, if you want to, refinance, at this point in time, then, what is the investor's appetite? And, my personal view, and I'm not a bond expert, but, I think that investors who are less familiar with FPSOs or, energy sector at large would probably be more conservative in this current climate compared to the banks. But I think you probably brought up a very interesting point. In markets like Brazil, I think project bonds are there to complement, bank financing, especially once the asset becomes operational.
Yeah, thanks, Melvin. And maybe Shiv, I'll ask you a bit about project bonds as well. I mean, everything I read suggests that project bonds are, time-consuming and complex, potentially expensive to issue. And even that some commercial banks these days are able to compete with bond investors in terms of tenor. So I wanted to ask, what you thought the potential disadvantages versus advantages were, and maybe talk about that point that Melvin raised. Can they only be used for refinancings, or can they be used as a tool for initial financings for FPSOs?
Yeah, I think maybe taking that last point first, I think that the reason Melvin has said that is the typical capital markets investor or bond investor make a decision to put their money into something, they put their money in there, and that's it. They want their return pretty much, from the get-go. And clearly funding, if you're funding during construction, you're not making any money for those 3-4 years. You're still building the the FPSO, which means you've got a negative carry if you try and use project bonds too early, which is why they're most likely to be used in refinancings. And then you strike on that point of, well, what's the point, right? Why bother doing a refinancing with project bonds? Yeah, look, partly it could be a price advantage. I haven't necessarily seen that, but there could be a price advantage depending on where the market is. I think a big part of it is just this hunt for liquidity. You know, it's what I touched upon earlier, and I think everyone sort of touched on that. There's a lot of projects coming on. They are getting very sizable. The bank market has its limits. A lot of them are in Brazil, where banks will have their natural ceilings in terms of how much they want to do with a certain counterparty. So Petrobras in Brazil, obviously, but even Brazil country limits. And so refinancing banks out of old projects and even ECAs out of old projects that are in regions like Brazil makes sense, because then that money comes back to the original lender, the bank and the ECA, and they can hopefully redeploy it for that contractor's next project. So it sort of keeps the capital available, and those banks and ECAs can stay in those early primary deals, do have construction risk. I mean, the other thing with the project bond market is that, you know, ultimately it's called project bonds, and therefore they can live with things like amortization of the loan, so repayment of the loan, which banks obviously like. They accept that there may be some element of covenants and waivers, which banks are used to. But typically speaking, they do want things to be a lot lighter than the banks do. They don't want to be dealing with a lot of issues with the project during the life of the project. So you will have to sort of come to a structure which will be slightly different to perhaps one that you're used to seeing from the banking market. And you may have to live with the fact that you don't have the same ability to talk to friendly bankers and friendly portfolio bankers if things aren't quite going to plan with your projects, just because of the nature of the type of investors that invest in bonds. Disclosure is another issue, depending on the type of bond that you go for, and you know how widely you want to disclose. Obviously, if you have a small syndicate of banks, you can sort of keep that disclosure within that group. But if you're going to a wider set of investors, you know, there may be some concerns from the charterer side in terms of disclosing some of the DD. But look, ultimately, to my mind at least, it's a worthy thing to look at, because liquidity is key here. And we are trying to find ways of making these types of financings, to keep these types of financings going, because by doing it in this sort of project style non-recourse way, you're getting a lot of leverage into the project, which means the equity return is particularly good for the equity investors. So if the banks aren't willing to do it, or aren't doing it to the same degree, and someone else is willing to do it, then it's worth the effort, it's worth the extra time. Because ultimately, you know, in the end, it'll pay off in the economics. I think the one point I'd say on the project bond side is that the investors are very used to infrastructure type deals. And that's a good thing with the FPSO. The FPSO is an infrastructure type piece of equipment, right? It doesn't take oil price risk. It shouldn't be taking any field risk. It's really an availability thing. And if you're an established contractor with a very good availability record, then actually it's fairly easy to make a case that this is an infrastructure type asset, and therefore, you know, something which you can sort of put your money into for a long time, which is attractive for a lot of those bond investors, and actually take, you know, and get the sort of returns and the sort of value they do from other types of asset classes. So look, for me, the key thing is here, it's not going to be straightforward. There's going to be new things to learn. But I think as the way the market's progressing, it's definitely something to look into very seriously, because having lots of options obviously makes life easier, and it makes it easier to get a lot of these projects done.
And just very quickly, I mean, as long as we're talking about project finance structures and infrastructure used in the infrastructure space, then I think we talked a bit about mini perms the other day. I mean, is that something that you see? Well, I haven't seen it being used, but is that something that could be used in the FPSO sector, like a hard or a soft mini perm structure?
I don't see why not, right? And the reason is, we haven't seen it much before. And the classic FPSO project financing has debt repaid well within the firm charter period. So the debt is fully repaid during that period, and there's no sort of lump sum of debt or balloon of debt at the end of the tenor. A mini perm essentially says, well, actually, your debt won't be there for as long. It won't be 10, 12, 15 years. It might be 7 years. But what we'll do is for those, you won't repay everything in those 7 years. You'll go along at a repayment profile that is, matching essentially what a longer term financing would have. So a 7-year financing would pay the same amount every quarter that say a 12, 15-year one would. But the difference is at the end of that 7 years, you'd have a big lump sum, which you've got to either refinance or repay. Now, that in itself is not very interesting if you think about it, because a contractor goes, well, I don't really want to do that because then I've got to deal with this refinance risk, and I don't know what the economics will be from the banking market or the project bond market in, say, 7 years' time. It might be that it's all a lot more expensive. I can't move my charter rate, so my IRR is going to be squeezed because I'm going to have increased financing potentially in 7 years' time. But the only reason it could be interesting is that it's quite common in the infrastructure space, particularly in Australia. And that's particularly because a lot of banks in that area aren't very interested in doing very long tenor financings. And if tenor becomes more and more of an issue for banks, and that is becoming an issue for banks from certain regions, right, the reasons you mentioned to do with their own cost of funding and their own way of match funding. Now, if that becomes more of an issue, then this could be a solution. It does put a problem back on the contractor, but at least it gets you that initial financing up front. And maybe the payoff for that is that higher charter rates will be potentially necessary because it'll kick on to that cost of the FPSO in total. So I think that there is definitely some scope to look into it. I think it'll be a last resort. And if banks really put their hand up and say, look, I can do it on a 7-year mini perm, but I won't do it on a longer tenor, then I think contractors look at it very seriously. And I think, for me at least, you've got to put it on the table, right? It's got to be an option worth considering, because if liquidity is becoming an issue, we've got to get creative.
Okay, thanks. Maybe now we move on to talk a bit about private equity and funds. And so when I think about this, I guess I think of equity investments coming in one of two ways. So the initial investment, so the FPSO contractor seeking JV partners to help fund its equity injection, or perhaps secondly, they come in later on as a way of releasing equity in a project that's up and running. So maybe I could direct this question to Siddhartha, a bit of a two-part question, really. First, do you think FPSOs are seen as stable, attractive, long-term investment prospects for private equity investors? And secondly, what are your thoughts on the benefits of raising equity through, say, JV partners such as the Japanese trading houses versus traditional private equity?
So we have seen actually some of the investors, the private equity investors coming in, and I think there are the Petro-First FPSOs, which probably are pretty well, market is well aware of, where First Reserve came in and took a piece. And even in our current discussions with PE players, I think we do see that there is an appetite for similar assets. I think the bigger challenge seems to be that the ownerships are extremely stable. And I think there has been a very limited effort by a very small number of players in the market to really go out and churn the assets. And to do it on a single asset basis, I think is also sometimes less lucrative or less interesting for the PE players, unless we are really talking about the Brazilian billion-dollar transactions. For a transaction to really make sense, I think there needs to be a portfolio of assets that needs to be looked at. What does complicate sometimes these efforts are that to start with, a lot of these FPSO projects are structured as JVs. You have existing JV agreements, and then parties may need to look at bringing in the PE player either for their own share or as a together with the partner. But I think there is interest, and I definitely see that given the kind of projects that are number of projects that are really coming into the market, and I think the quantum of financing that would be available, especially for the construction financing, I think there is a definite need for the players to look at their existing operating portfolio and talk to midstream and talk to PE players, etc., who like the midstream nature of these assets. So that's a very short, that's the answer to your first question, and there's definite interest. I think on the second part, it's needless to say that the Japanese investors or even broader minority strategic investors have shown appetite to come into the bigger, broader projects and bring in equity. It's very important, and I think Dindo touched upon it earlier, that fortunately or unfortunately, the FPSO project financings have got a shape, size, character of their own, which includes a completion guarantee. And it's very important to have a partner coming in at the construction period who do have the creditworthiness and credibility to not only put in equity, but also stand behind a portion of the debt. And there is obviously an interest there, but I would say that more and more, I think not only for the investing community, but also for the financing community, I think the construction risk is going to become something which is bigger than what we have seen in past. And that would actually mean that there might be, I think there may need to have more discussions, and I think fewer parties in terms of equity interested to come in with the kind of check that is needed for pre-construction financing or pre-construction investment.
Thanks. Yeah, I mean, you talked about the Petrofirst deal, so maybe that would be a good question for me to ask Melvin. Obviously, we worked on that together. So I wanted to ask Melvin, what do you think of that structure, this sort of infrastructure fund? Do you think that that's going to be used more going forwards? And could that be something that's used as a method of raising financing upfront for a project, or you see it not being used so much, or if it is going to be used as something that comes in later on, and assets that are already up and running get moved into those sorts of funds?
Yeah, no, I think so. I mean, private equity definitely has a role to play, in the FPSO world. The question, I think, going back to Petrofirst, I think context there was slightly different because Petrofirst wanted to get out the FPSO sector and focus more on the EPC. Business, which kind of prompted them to, move away, or sell the FPSO business to First Reserve. But I think we have to be clear. I think for private equity, the equity returns are not cheap by any standard. If anything, it's probably higher than the strategic investors. I think the other interesting thing to note on the private equity side is that they are not confined to equity. They can also invest in mezzanine instruments. Depends on how you look at mezzanine. It could be expensive debt or cheap equity. But clearly, I see at least some role on the private equity side. In some ECA finances, where the senior debt amount is capped by the ECA requirements. That's probably linked to tenor. So to achieve that sort of optimal debt sizing, then private equity could come in, to provide some mezzanine to bring up the to debt to an optimal level. But coming back to equity again, they are not cheap. But they are indeed there as a source of liquidity.
Thanks. Yeah, I'm just conscious. I see that we've got a bit of time left, about 12 minutes. So I think maybe we won't talk any more about particular structures that we're seeing. I was going to talk about MLPs, although there's probably not much to say anymore about MLPs. So I know people will be interested to talk about current risk factors. And so regardless of the source of financing, we're going to be looking, finance is going to be looking at the same risk factors, especially in the current market environment, of course. So one question, perhaps I'll ask Dorian this question, is how you look at the relative importance of the creditworthiness of the contractor group versus the charterer group, and indeed whether you just look to the charterer payment risk or whether you're looking deeper into the project. And if you don't mind, I'll ask a question that has come already from the audience on that in that respect, which is that banks have traditionally been reluctant to take reserve risk in FPSO financings, with a potential move towards a more alliance or risk sharing contractual lease and operate model. How do you consider financing? Would you consider financing these types of structures?
Okay. The rule number one in FPSO financing for a bank is to not take any reserve risk. So historically, you effectively look at the charterer or its guarantor and the contract, I would say. Things have changed in 2015 and have remained the same since. So whatever the oil price came down again, I think, I believe it's the same for all my colleagues on the line today. You are looking now more and more since 2015 at the upstream asset. You don't want to face a situation where the oil price is going down, potentially the gas price, and the upstream economics are tighter, and we don't want that to be an incentive for the charterer to try to renegotiate the charter rate. Why that? Because starting 2015 or 16, that's when the offshore oil and gas services were really under a lot of stress, because all the majors, all the large international oil companies starting to renegotiate everything. The one sector which remained a bit immune from that is the FPSO 1. So, but you still want to be careful. You don't want to finance an asset which break-even would be at 35, and then 2 years after, your oil price can go down as low as 20, basically. And if you ask all these contractors, all the main players in the FPSO space, they would all tell you the same as well. Since 5-6 years, we have changed our approach. We try to also look into the reservoir to be more confident and to not face any issue in the future. And more, the banks are also providing, as part of the syndication, when they introduce a project to other banks, they will come up sometimes with a reserve report or a light one, or more high-level one, in order to give confidence to all the banks that the economics of the upstream are okay, the reserves are there are sufficient reserves in principle to meet the charter tenor as well. So you look at all that. This is what has changed compared to before 2015. And I believe it's the same for all my colleagues here. When you go through your stress test, when the oil price is under a lot of pressure, the first question you may have from your credit team or your risk team is, what is the oil price break-even on this field, to see if yes or no there is a risk on your contract and the charter rate, basically. So all these elements are fundamental. Probably no need to insist too much on, yes, we will definitely look at the charterer, its credit profile, the charter contract itself, the termination payment, and we rely a lot on you, Ben, to review that in particular, the termination for convenience, etc. But all that has been complemented by the upstream analysis since a few years.
Thanks. Yeah, no, that's I'm sure everyone, if I were to ask the other panelists, I'm sure they'd all share the same view. So maybe I will ask Dindo a different question in terms of risk factors, the one that's on everyone's lips, which is the impact of COVID. I mean, we have seen to date the impact of COVID on shipyards in terms of delays, financial constraints, force majeure, etc. Albeit people are, we're hoping that we're coming out of this period. So I wanted to ask your view. Are you more cautious now? I mean, I guess yes, but I'd like to ask you a bit more about the factors you're cautious about now going forwards from this situation we're currently in respect of COVID.
Sure. Thanks, Ben. I mean, for me, COVID itself is only temporary. Hopefully by next year, this will be all gone. We have the vaccine and everything, everyone is happy. But then the question is, how did this COVID affect the counterparty risk? Has it been impacted them on a very negative basis? What's happening to the contractors, the shipyards, what's happening to the charters, the oil and gas companies, what's happening to the field, especially if it's a just marginal field. So we'll have to look at those risks, how it impacted them. And if it has a very big impact on them negatively, then of course we would be very, very cautious on taking this risk. So for us, especially for project financing, we'll be looking at counterparties that were able to get out of this COVID pandemic stronger, or basically still safe. And we would look at the cash flow. and hopefully that it will all still be very safe.
Okay. Look, turning to another risk factor, I guess, is one that Petrobras has looked at, is the challenge in handling the demand for FPSOs in Brazil. And they, have cited, of course, the capacity of contractors to take on so many big projects at once. There are only so many FPSO contractors who are able to execute these huge projects. I think MODEC is currently working on 7 FPSOs, 5 of which are in Brazil. So the recent Petrobras lease and operate tenders that we saw only attracted 2 or 3 proposals each. So in order to improve competitiveness, Petrobras have suggested that there be a shift in contracting strategy to maybe build, own, transfer BOT, or build, own, operate, transfer BOOT model, which they say is aimed at reducing day rates and improving competition. So Siddhartha, as I said, Petrobras have said that it's basically due to difficulties in securing financing at affordable interest rates for long-term FPSO contracts as one of the main reasons that chartering costs have risen so much, and that they therefore considered this shift in strategy. Do you think that's right? And what do you think of these new contracting models from a financing perspective and attractiveness?
To answer this second question, indeed, it is correct. I think the FPSO industry, and I think if we just go beyond number of projects coming from Brazil, actually, if you look at the quantum of financing being raised within FPSO space and how much of that is concentrated in Brazil, I think that's a huge chunk. And it's not only banks, but I think ECAs themselves are facing challenges in terms of having the right amount of limits. There's obviously, when the bank limits start getting stretched, you do have the option of Chinese, let's say, leasing financing, etc., which we have talked about is more expensive. So I think it's not only a question of the cost of financing, but quantum and the liquidity, which I think has been a challenge, especially at the pace at which Petrobras wants to move. Now, I am slightly familiar again with those contractual structures which Petrobras have tried to test with the market, and I think they are pretty useful, I think, for a very specific risk. I think what they don't do is take out or release the Petrobras limits. If that was the intention, I don't think that goes on and addresses that, because actually the risk gets more concentrated in Petrobras, because in some cases, even the construction risk in some models is taken up by Petrobras, depending on how the construction milestones proceed. But I think what they really do, and I think that might be something which is more attractive for Petrobras, is that they bring in more players with probably not a balance sheet which somebody like MODEC can, or the credit rating which somebody like MODEC can actually show, but maybe the other names who may not be able to get a construction financing. I think, as I'm continuously saying, I think in the current market, it's the construction financing which is a bigger risk. And if that risk to some degree can be assumed by the Petrobras contractual structure, then it would bring in some of the other players who possibly have the right set of people, the right set of skills, and being new player, I think they may probably be doubly cautious to ensure that the delivery is right. So I think it would definitely open up the market and make it more competitive for the new developers to come in without being constrained by construction financing. But I would still question whether that would, especially in a post-COVID world, be effective in case Petrobras wants to release the limits in themselves.
Okay, thanks, Siddhartha. We could have carried on for, oh gosh, probably at least another hour. We haven't even touched upon energy transition really, but I'm being told that we've reached the end of our session. So I'm afraid that we'll have to end here. I'm sure that we'd all, myself and the panelists, be happy to answer any questions that anyone has after the event, whether by email or otherwise. So just would like to thank all of the panelists for their time. And I will hand back over now to either Jamie or Dave.
Thank you. Thank you very much, Ben, and thank you very much,
Thanks,
Mel.
guys.
Dave, do you have anything to add?
No, it was good. There's almost too much information, but it was great to have such a broad spectrum. It whets the appetite for more. I think we could have a whole day on the subject.
Yeah, in
Next
future
year.
we will create a separate day just for project financing. But don't forget, ladies and gentlemen, you can go to the meeting hub and connect with all of the people on our panelists on this panel, and you'll be able to connect with them and speak to them and carry on the conversation even after this panel itself. So once again, thank you very much, gentlemen, for your time. We do have one final session that's happening in just about 5 minutes. So I invite all of you to head back to the agenda timeline and click on session 3 for today's last day of the FPSO World Congress Live. We have a final session on assessing the reality of the global COVID-19 pandemic and navigating its impact on the FPSO market. See you there.
Thank you.